It's that time again to highlight the shifts in our investment recommendations from our hot off the press Strategizer publication. Our S&P 500 equity model score continues to point to very subpar future returns 1 year out as valuations remain really stretched, and the analysts have been far too quick to price out the earnings recession. At the sector level, we remain very defensive and rate sensitive. Telecom services retain the number one spot, where the sector has been since March, and very quietly has turned in an impressive 19% advance over that period on the back of strong earnings revisions and relatively light investor positioning. Energy has jumped to number 2 spot from number 4 thanks to this recent upswing in oil prices, and valuations remain quite compelling. Financials and industrials are the two sectors that saw scoring erosion over the past month. So our advice is to rotate out of these two sectors and into telecom and energy. That is our advice for sector rotators looking to add alpha. The Canadian equity model, well, that continues to show relative strength, and sector-wise, we are emphasizing healthcare, energy, and even the beaten up financials as top screeners. Internationally, Asia ex Japan has seen its scorecard improve to the best level since last November, and our research shows there to be far too much investor pessimism, even applied to China. Our European model at the same time, well, that's neutral. It does compare better to the United States, but it is not as attractive as either Canada or Asia at the current time. Both these regions, extremely attractive valuation support. I cannot stress that enough. The Strategizer continues to flash a green signal for bond duration in the face of Treasury yields moving higher, even as economic growth continues to slow as far as the outlook is concerned, and inflation pressures are subsiding. Our models say will continue to subside. In fact, our bond model hasn't been this bullish on Treasuries since last November, which foreshadowed a 30 basis point decline in the 10-year Treasury note yield over the ensuing 3 months. We're also seeing crosswinds emerge in the land of corporate credit. Our recommendation, best to step up quality with single A corporate bonds screening the best. Within the FX market, the US dollar rally looks way overextended right now. We continue to see the woefully undervalued Japanese yen as a spring coil ready to bounce. We're still neutral on commodities overall, but energy and gold are looking most appealing at the current time. For more information on our Strategizer model, please email us at information@rosenbergresearch.com. Thank you.